Tonight on Market Call, David Burrows is on the show. He's President and Chief Investment Strategist at Barometer Capital Management, taking your questions on North American large caps. Hello, I'm Greg Bonnell, filling in for Catherine Murray. Welcome to Market Call tonight. Call us, it's toll free, 1-855-326-6266. Send us an email to marketcall@bnn.ca or tweet us at marketcall. You can also upload a video question, film a quick question on your device, tag us in your post, or send us an email with the clips. And be sure to put video questions in the subject line. Your question can be answered by one of our guests during the show. Welcome, David. We had a pretty interesting day on the markets. Want to start there. Usually when I talk about what moved the TSX, I look at oil, I look at gold. Was it bank earnings? One stock story today, Valiant.
Right. It's a very tough situation because it became over time such a big stock in the Canadian market. And, you know, I think it highlights something that's really important to always remember, and that is, you know, when you make an investment, you look for something that fundamentally makes sense, where the numbers support your investment. And we have a belief at Barometer, you also have to have the price of the security doing what it should be doing, given what you think you know. So you're trying to buy things that are changing for the better. And if your fundamental picture is getting better and the price is behaving otherwise, you have to question your assumptions. And so we have a big belief in using stop losses. And we talked actually, I think going back maybe 6 months ago when Valiant started to come out of bed, about the fact that, you know, the way that the price was behaving, given the fact the sector was starting to sell off, but this one was behaving worse, you know, might give you some pause. And it's always interesting because you'll have fundamental analysts defending a security all the way down. But the problem is, once a stock that's been in favor falls out of favor, you've got an army of people just waiting for their opportunity to sell and get their money back on any kind of rally. So you get all this built-in selling. And then, of course, if you wind up with a problem and you have unhappy shareholders, there's not a lot of people who want to step up to give more funds to the company if they need to raise additional capital. So here you have a company now with like $30 billion in debt, and the equity is evaporating.
It's cut in half today.
And it's not a pretty picture. And so it just highlights how important it is to have some discipline around selling, and especially in an industry where portfolio managers and analysts are paid to say, I'm right, the market's wrong. Ultimately, the market gets it right. So you just really have to be prepared to pick up on the message of the market. I think, you know, buying a stock like this here is kind of like picking up dimes in front of a bulldozer. You know, there's a lot of people who would like to be out of this situation, and sadly, there's a lot of people trapped.
Yeah, you talked about discipline. Obviously, it's been a tough year testing a lot of investors' discipline so far. The volatility that we saw in January and February, it looks like we're getting into at least some gains in March. Are things sort of shoring up now, and where are we headed for the rest of the year?
So when I was on in January, we posed a view that this was the first significant correction of a new long-term bull market for stocks. And if you look back, the S&P 500 broke out to new highs at the end of 2012, exceeding the 2000 highs. So 12 years of sideways markets resolved to the upside. And if you go back and look at the two previous secular multi-year bull markets, one that started in 1951 and went to 1966, or the one that started in 82 and went to 2000, in both cases, about 2.5 years in, you got about a 10% correction over 6 or 7 months. In both cases, having had been through a tough market, lots of people said, oh boy, here we go, we're back into trouble again. And almost on a dime, in both cases, the market turned and rallied between 100 and 150% in the next 2 years. Now, I'm not saying that's where we are today, but I will say, I think that this was, and we've passed it, the first significant correction of a new longer-term bull market for developed market equities. And we're very bullish.
Now, bullish on Canada as well. When I talk to a lot of investors there, they like the States, they like some other areas, they don't like Canada so much.
That's a great question. So what did well in equities from 2000 through 2012 was emerging markets driven by China. And of course, all the suppliers to China. And Canada, of course, is one of those. So the resource sectors were big beneficiaries, and Canada was a big beneficiary. I think where we are today is we are going through now a long down cycle for commodities. And there will be retracement rallies like we're having right now that will make things look a little better. But in general, if you can have low inflation and low input costs, especially energy, that's a great thing for a developed consumer-led economy. So of course, the biggest one in the world is the US. 70% of the economy is consumer. So US, probably Japan, developed Europe probably does the best going forward. And it's not like it has to be perfect today. It just has to slowly get better. And if you looked at the market from 82 through 2000, the US economy just slowly improved based on technology, and I think low energy prices and technology favor the U.S. as it is today.
All right, fascinating stuff to start our discussion. We're here for the hour. David Burrows is the man in the seat, President, Chief Investment Strategist of Barometer Capital. He wants to answer your questions about North American large caps, so give us a call. It is toll-free, 1-855-326-6266.